Hello and welcome to Portfolio Matters, Oil Market Special. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Thank you, Richard. So the oil price has been going nowhere since it peaked in 2022 post-pandemic, and it's been drifting down. The IEA are forecasting that there will be a global glut of oil amounting to 4 million barrels a day, which is enormous in 2026. But I think the oil cycle is beginning to turn, and medium term, that there are good reasons to believe the oil price will be very strong. So what we're going to do is the classic, I'm going to tell you what I'm going to tell you, I'm going to tell it, and then I'm going to summarize. So the point of this podcast is that the global oil supply shock that was caused by the development of US shale that brought an amazing 11 million barrels a day into the market is now coming to an end. And that oil supply shock has essentially kept oil prices low for 2 decades. And during that time, oil demand actually grew. We think that shale started in 2006 roughly. Well, in 2006, global oil demand was around 85 million barrels a day. It's now 104 million. Now, during that time, everyone was talking about peak demand and the energy transition. Well, that doesn't appear to be happening. Instead, all the forecasts are that oil demand will now keep on rising. The EIA, for example, are forecasting demand will rise by 1.1 million barrels a day in both 2025 and 2026. When you look at where demand is coming from, it's not coming from the OECD countries. It's coming from developing countries, particularly India, Brazil, etc. There is little sign of demand growth from emerging economies slowing in any way. But the market is currently oversupplied. As I said, the IEA are forecasting an enormous oversupply of 4 million barrels a day in 2026 because OPEC Plus have increased production this year, and they're apparently not going to continue increasing production next year, but they are causing an oversupply. However, when the current glut fades, then I think we are set for a sustained period of oil price growth because the supply from shale is peaking and will start to decline. We haven't invested in new exploration and production, and the decline rates of existing production mean that we're going to struggle to meet growing demand. Now, historically, I've always played the oil cycle because the oil cycle is very violent. The great thing about oil, the good and bad thing about oil, is that supply and demand are very inelastic. So if the oil price doubles, you still have to fill your car up. You are relatively price insensitive to the price of gasoline. But also, it takes a long time for high prices to feed through to new supply because it takes years to find and drill new oil wells. Now, that changed when US shale came on board because production of US shale is rather like a manufacturing process. You just go out and drill some more wells, and then within a year, you've got more oil rather than 5 or 6 years for drilling a traditional well, even longer for offshore. And now shale is peaking. then it looks like, and I'm forecasting, that we're going to go back to a more traditional oil cycle. But this is not immediate. We are talking when the current oil glut ceases in 27, 28, but is something I'm going to be watching. So this is basically teeing you all up for the next oil cycle, which is not yet, but is coming into view. Because we've not been investing in new supply and shale oil is peaking, and we'll take you through a load of graphs illustrating that, and oil demand is still rising. When the two curves, the demand and supply curves, cross, it will mean oil prices start to rise, inflation will rise, and traditionally it is rising oil prices that cause recessions. So economic activity will fall, and essentially the oil market will take a wrecking ball to the world economy. So you need to be aware of that and move into oil and start thinking about moving out of anything sensitive to oil. So currently, this is not advice, but I'm just sitting tight, but preparing to buy oil companies when the current glut fades. Now, one of the characteristics of the oil market is that there is relatively little storage capacity, and so the spot price is quite sensitive to market conditions. So as we get the oil glut, it is unlikely that the oil price will be able to make any headway. It's likely to fall. So this is a chart of world energy consumption over the last 50 years. And you'll see that all those predictions about the energy transition causing lower fossil fuel demand have just not been true. Even coal consumption has been rising, but oil consumption has been rising continually, and there shows little sign of peaking. The EIA is forecasting that it will continue to rise to 2050 over the next 25 years, and it will grow in that time from 104 million barrels a day to 125 million barrels a day. That is a lot of extra supply that will be needed to meet that growing demand. And we showed you earlier the price, the oil price. This is the long-term price adjusted for inflation. And adjusted for inflation, you'll see oil prices are where they were in 2006, just when the US shale boom was getting started. The 11 million barrel a day supply shock from US shale has supplied growing world demand and kept oil prices low for 20 years. Okay, so an overview of where we are. So remember this, during the pandemic, everyone was talking about peaking global oil demand because of the energy transition. BP was reducing its investments in future oil supply because they would be stranded assets, according to Greenpeace, and they were forecasting that oil demand would peak. Well, nobody thinks that anymore. It didn't peak. It kept on rising, and as we've shown you previously, it's now forecast to keep on rising. And that's because demand from the emerging economies continues to rise. If you look, this is oil demand in India, and you'll see that just keeps growing. Brazil, exactly the same. So although oil demand in developed economies such as Europe has peaked, it's not falling much, and demand is growing outside developed nations. And these are the forecasts from in Orange, it's OPEC. They're forecasting it'll reach 120 million barrels a day by 2045. The IEA and the BP, who both believe in the energy transition, have been forecasting it would decline. But so far, there's little sign of that. And this is total global oil production, and it's now hit a new peak as of July. Note that although we're consuming about 104 million barrels a day, this is just crude. The difference between the 86 million and the 104 million is natural gas, liquids, etc., which aren't classified as crude in this chart. This year, total production has grown by 2.7 million barrels a day. OPEC have been responsible for 1.5 million of that, non-OPEC 1.3. So we know that demand grew by about 1.1, and so hence you've created an oversupply. And if you look who's been responsible for that, it's Saudi, Brazil, Kazakhstan. Note the US is no longer the prime contributor to global supply growth. And in July alone, global oil production increased by 870,000 barrels.
Can I just chip in there, Keith? Because what hasn't happened is that storage hasn't gone up, has it?
It has. We'll show you that in a bit.
Does it? Does it?
Yes. So if you look at the world ex the US, it again hit a new high in July. And this is where the growth has come from. The green line is Argentina, Canada, Brazil, Guyana, and the US. You've had growth of best part of 8 million barrels a day over the course of the last 10 years. But if you strip out the US, then actually the growth has been much smaller. It's been only about 3 million barrels a day. The US has been responsible for most of the supply growth over the past 10 years. Now, looking at OPEC, we know OPEC have been opening the taps recently. And so you'll see here their production is growing back, but is not anywhere near peak. We know that Saudi still has spare capacity. Now, what I think OPEC are doing is OPEC can sense that they are regaining control of the oil market. So because previously, when they took oil out of the market, it didn't have much effect because US shale could simply open the taps and fill the market. Now, what they're doing is they're opening the taps, flooding the market, driving the price down, but then when they take oil out of the market, there's going to be nowhere that can replace it, which means they are back in control. They have pricing power in a way they haven't had for the last 20 years. So in September alone, OPEC production increased by 520,000 barrels a day. And when you look at what's happened over the past year, you'll see that Saudi Arabia has increased production by the best part of 1 million barrels. UAE, 400,000. Going through the OPEC members, so Algeria production seems to have stabilized. And when we talk about why this forecast could go wrong and where new supply could come from, Algeria has enormous shale oil and gas reserves that are a potential source of new supply, but it has yet to begin exploiting them. It has issued the first exploration licenses to allow companies to start producing from the shale, but as yet they're not doing so. This is Iran. So new sanctions, are they beginning to have an effect? Iraq, they have been playing nice recently because they've been cutting production to compensate for historic overproduction, but they certainly have spare capacity. Kuwait, increasing production in line with their allowance. This is Libya at a plateau. Nigeria have actually reversed what I thought was a permanent decline. So that's quite good news, but the absolute increase is quite small. Saudi certainly have extra spare capacity. Could they get back to 10.5? They claim they could go to 12, question mark. UAE have been investing in new capacity. They certainly can grow. Venezuela, basket case, but they have the biggest oil reserves in the world. If there were regime change in Venezuela, they could be a key source of new supply. It would only take a few years for them to get back to 2 million barrels.
There's not much chance of that, is there, Keith? I mean, there's no.
Yeah, they don't have a bullying big neighbor to the north.
No, they don't. There are no aircraft carriers or anything in the region.
Well, we'll see. So the EIA estimates that OPEC retains spare capacity even after opening the taps. So bottom line is that OPEC has been taking advantage of a tightening global oil market to assert control. They're driving the price down now, flooding the market, which will cause lower prices and a lack of investment. And then when they take barrels out of the market in future, they will have pricing control. Now, looking at non-OPEC, this is Angola, basket case. Argentina, well, they have been exploiting the Vaca Muerta shale play, and actually their production has grown a lot and is forecast to keep on growing. So this is from Rystad Energy. We are in 2025, and they think they'll reach 1 million barrels a day by 2030. So in the terms of the global oil market, that's not a huge growth, 500,000 barrels over the course of 5 years. This is Brazil, which has been growing, and Brazilian oil production is forecast to keep on growing for the rest of this decade. You're looking at the chart in the middle here, and you guess most of the production growth, according to this chart, is coming from land. But when you look at Rystad Energy are forecasting continued growth in Brazilian oil production. We're talking about an extra 2 million barrels a day by 2030, all of it coming from ultra deep water. And I think this is right rather than the previous one. And so Brazilian output has rebounded sharply this year now, but Barclays disagree with Rystad Energy. They think that Brazilian growth will slow next year due to increasing decline rates. But let's be pessimistic and assume that Rystad are right and that Brazil will keep on growing. This is Canada, steadily increasing, but notice the marginal rate of increase is quite small, around, let's say, 200,000 barrels a day per annum, not huge. And at some stage in the near future, depending on the oil price, Canada is going to start topping out. China has actually turned itself round in quite an impressive manner, but again, not huge incremental growth coming out of China. Kazakh oil production, we know that oil production has surged this year due to a new production plant in the Tengiz field coming into line 6 months earlier than planned. But forecasts are that Kazakh production is now going to be flat going in the future. Mexican oil production has stabilized, but little sign of recovery. Norway, again, no, little growth. Oman, little growth. stable but not growing. Qatar, highly managed, but probably some growth there. But, we're talking about very stable production. Russia, clearly being impacted by the war and Western sanctions, also has huge reserves. Guyana, now this is interesting. Guyana going in the past 5 years, Guyanese production has grown from naught to 700,000 barrels a day, and then it's going to rise to 1.3 by 2030. So there's decent incremental growth coming from Guyana, but not huge. But the big one is the US. Now, we're doing this podcast because it looks like the US is peaking. So it's not merely the fact that growth is stalling. US oil production will now start to decline. However, the industry has consistently defied expectations, including this year. So we're going to have to watch this in the future. And I'll be reporting US oil production every podcast and global oil inventories every podcast from now on. But reminder, the EIA is forecasting a supply glut throughout 2026. And as global inventories fill up, so the oil price will be under pressure. You'll see that they're forecasting the oil price will fall to the low 50s next year. Not a good time to be buying oil companies, I'd suggest. So this shows world production in blue and world consumption in brown, and you can see they're forecasting production to outstrip consumption throughout next year. Barclays are calculating that non-OPEC plus supply growth will start to slow in the second half of 2026. So if we go back, you'll see that production growth from the EIA is forecast to keep on rising in the latter half. Barclays are saying that's not going to happen. Consumption, though, is forecast to keep growing, as we've said. As a result, inventories have been rising this year and are forecast to steadily rise throughout 2026 to hit the upper range of the historic levels. And this is the exploration spending of the majors, and you'll see that it's basically halved in nominal terms over the past 10 years. Nobody's been doing any exploration because all the marginal supply has been coming out of US shale. And 2025 has had lower upstream investment than the past couple of years, as lower oil prices have started to bite. Global oil reserves have been falling. So this is, on the y-axis, proved reserves to production ratio. And you'll see been falling. And that is setting up tightening supply in the future. We've been consuming known reserves without replacing them. This is for the major oil companies. So the bottom line for non-OPEC countries is that their potential to raise output in the coming years are, and we've gone through these charts, Argentina about 500,000 barrels a day, Brazil about 1.5, Guyana 700, Canada 500. So that totals about 3.2 over the next 5 years, during which demand is forecast to rise by about 5 million. Now, there will be contributions from other countries, but you can see that supply and demand will fall more into line over the coming years. But given that we're having a glut of up to 2.6 million next year, it's not clear that you will start to have more demand than supply on this reading. A lot is going to depend on how production from the US evolves. So let's have a look at US shale. Now, these are really important charts. and they show the gas oil ratio in the major US Permian oil plays. And the Permian is responsible for all the incremental supply growth in from US shale. So on the y-axis, you've got total production per day. And on the x-axis, you've got the gas oil ratio. And this is for all the wells in Lee County, which is one of the key counties for production from the Permian in New Mexico. And you'll see that over time, production has grown, but the gas oil ratio has also increased. So in order to produce 1.2 million barrels a day, you're producing more and more byproduct gas. So the geology is now starting to work against you. You've moved out of the core central area of the Permian. You're starting to move into the more marginal areas where you're getting less oil, more gas. This is Eddy County. Again, you've had this steady increase in the gas oil ratio, but Eddy County is less bad than Lee. Midland, notice that absolute production in the Midland County from the Texas Permian is now down, actually quite a long way from its peak. The peak was in 2023, almost 700,000 barrels a day. You're now less than 600, and gas oil ratio keeps on increasing. Martin County, same pattern. Less oil being produced, more gas. Reeves County in the Texas Permian, declining oil production, more gas, less oil. Loving County, same story. But having shown you all that, despite the declining geology and a falling rig count, production in the Permian hit a new high in August. Now, Peak Oil Barrel, where I get most of this data in the charts from, described this rise as difficult to explain. And it can only be caused by rising productivity per rig. Now, remember, it's per rig, and we'll come back to that in a bit. So looking at the other big shale oil regions in the US, the Eagle Ford, that peaked a long time ago and is now in decline. The Bakken peaked a long time ago and is in decline, although, production is broadly stable. Lower oil prices have meant that in everywhere, all the shale plays in the US has seen a declining rig count and declining number of wells drilled and completed. Look at the left-hand chart here. This shows the normalized well cost in millions of dollars per 10,000 feet of lateral. So it's a lateral is the underground fracking well that's drilled horizontally. And you'll see between 2011 and 2021, the price per 10,000 feet fell continually. So you're getting increased productivity in the drilling efficiency. But since then, it's been rising, and actually rising quite substantially. So you're no longer getting improved productivity in drilling. Now, the good thing about the consolidation in the shale patch, majors have been buying up all the small independents, and they have much better capital discipline. So you'll see back in 2011, the small independents were just drilling like mad. So they were plowing back 300% of cash flow into drilling more wells, and hence the oil price collapsed. Now, the majors are imposing capital discipline, and they're only plowing back, what's that, 60%? So it's no longer, drill at any cost. Now, so far, we've had a puzzle in that I've shown you the geology is declining, but absolute production has been rising despite fewer rigs in operation. So you've had higher production per rig. But if you look at it per 10,000 feet of lateral, and you're looking at the right-hand chart here, that agrees with the geology. Production per 10,000 or 1,000 feet of lateral has been falling. What's been happening is that each well is bigger. So you've been drilling further per well. When you get the rig in, you keep it on one well for longer and you drill more laterals from that well, which are longer. So your production per rig increases, but production per lateral has been falling with the geology. And so the EIA is now forecasting that US production from all the shale regions has peaked and will now start to decline. Now, the trouble with all these forecasts is they are oil price dependent, in that if the oil price were to double, profitability of all these wells increases. And although the geology is declining, if you were to double the number of rigs in operation, you would undoubtedly increase the amount of oil coming out. So peak oil barrel have made various forecasts for the future oil production from US shale plays based on the total size of the resource. And so their median forecast is that US shale production will now start to decline. If the resource is on the high side of estimates, then it will be on a plateau now for the next 20 years before declining sharply. But their median forecast is for it to start declining. JP Morgan also thinks US shale production has peaked, and this is quite important. So they're saying that by 2027, it will be down by 1 million barrels a day. That's big. Goering and Rosenzweig, I hope I'm pronouncing that correctly, also predict that Permian production has peaked and will now gently start to decline. They point out that the Permian produces about 5.7 million barrels a day. So each month, 500,000 barrels comes out of production due to very high decline rates and must be replaced by new drilling. Now, the reality is it is always replaced by new drilling. So that is not necessarily anything to worry about. But you see the gas cut. So you're looking at the right-hand chart here. The percentage of oil keeps on declining. So this week I had my usual weekly call with my US fund manager friend who lives in Texas. And he flew over the Permian last week at night, and he said it was lit up like a Christmas tree. So all these wells, essentially the gas that comes out of them is increasing. There's limited export capacity for the gas. And so the price of the gas is very low. And when they can't export the gas, the producers are simply flaring it. So these are forecasts from the EIA, and they're forecasting that in 2026, i.e. next year, US shale production will fall by 100,000 barrels a day. Another part of the EIA, however, is forecasting that total US oil production will keep rising in 2027 and then be on a plateau until 2029 and then start falling quite fast. So the thing is, I'm not forecasting we're going to get a tight oil market yet, but frankly, by 2030, if this is true, the oil price is going to start going to the moon, because there is no way that the market can start replacing all this fallen production from the US. Having said all that, production from the US surged in Q3 in a way that absolutely no one was expecting. And I've yet to have a good explanation for this. And this was despite the falling rig count. Now, it seems to be fading again now, but the exploitation of US shale is essentially a technological revolution.
Do we have a chart, Keith, that shows the production per foot, or whatever the measure is, of drilled lateral?
Yes, that's the one I showed earlier.
So, what
Yeah.
does that explain, this increase then?
No, because unless they drilled a hell of a lot more lateral. Yeah, that's
Because if they're
true.
drilling more laterals and longer
Yeah, that's true. Per rig. Yes,
per
that
rig,
would explain it. Yeah,
yeah.
that would explain it. Yeah.
I guess that's the answer, isn't it? They're drilling longer laterals, they're drilling more laterals per rig, but they're also then depleting faster.
So, well, this is the rig count.
So the rig count's declining, but the number and length of laterals is increasing.
Yes, has to be. Good point. So the bottom line is the supply shock from US shale is, and US shale oil production will now start to decline, and total US oil production will follow thereafter. Now, how quickly it starts to fall will determine how quickly the global oil market falls back into balance and then goes into deficit. So this is what we need to be watching in the coming years. Now, on Richard's point about the oversupply, is it showing up in oil stocks? Well, yes, it is. Oil stocks are growing really quite quickly. And reminder, the IEA is forecasting a glut of 4 million barrels a day next year, which is enormous.
Where are the oil stocks, Keith?
Antwerp, Rotterdam, Fujairah in the Middle East, Singapore, etc.
Because the strategic oil reserve isn't being refilled, is it?
Includes strategic petroleum reserves.
So the US SPR isn't being refilled at the moment, I believe.
Actually, it is, but not by very much.
Yeah. There's also, I think, there's a lot of oil on water, isn't there? Oil in tankers that hasn't been discharged.
Yeah, well, that's going to get worse if there's a lot of oil. If we have a huge oversupply next year, everywhere I looked, you could see confirmed that there was growing oil inventories. So this is from Macro Micro Me, which is Yardini research. You see that in the last year, we've had rising inventories. And when we look at the big oil fields, it confirms that they're either in decline or they're topping out. There are no big new oil fields coming online that are anywhere near the size of the historic ones.
Do you think that Gawa, Saudi Arabia, really have the capacity to boost production back up to that high level that they're talking about?
No, I don't think they do, but they've got other oil fields. Gawar has been in decline for a long time now. And so this is the oil curve, the futures curve. And you see that they're forecasting that the oil price next year, like in February 2026, will be at about $64. And the point is not really the absolute numbers, it's the shape. And so they're saying that the oil market won't really come back into balance until 2030. So in order to keep track of this, I have added a line in the weekly, so watch out for this, and that is global oil inventories as reported by the EIA each month. And they're saying this year it's increased by 144, is that million barrels? No, it can't be 1,000 barrels. So my thesis is that The decline of US shale is going to cause essentially an irredeemable tightness in the oil market in the coming years, which will lead to an enormous oil spike, which will be a wrecking ball for the world economy, as it always is, because US shale was a huge supply shock, and when that supply shock starts to fade, we have nothing else to replace it in the short term, and oil demand keeps on growing despite what everyone says about peak oil demand and the energy transition. So what could go wrong? Well, US shale could continue to grow if there is improved technology, but as we've seen, the productivity seems to have stalled and has been falling. Both oil production per 1,000 feet of lateral and the cost of drilling that 1,000 feet of lateral have all increased. You could have a lot of new supply coming out of Russia if sanctions are lifted and Western oil companies return. Then Russia could add what, 2 million barrels a day back to up to 11 million barrels. But as people on the Discord have pointed out, geopolitics and lack of technical expertise likely to constrain Russian supply in the future, as they have done in the recent past. Shale oil reserves elsewhere in the world could be brought rapidly on stream. Now, the thing about the US is it has an enormous shale resource, but also it had nearby energy infrastructure, the capital to put in all the pipelines, and water. You need water to frack the wells. China has got a lot of shale, but it's in the desert regions. It's going to be difficult to get water to frack the shale. So Argentinian supply from the Vaca Muerta is growing. We know Russia's got enormous shale reserves. Russia could be the country which is next exploiting shale in size. Algeria also has shale and is selling licenses. Kuwait found an enormous shale oil field, but they contracted Eni to start exploiting it, and this was in 2020, and we've heard nothing since. So presumably they failed. That shale oil field was offshore, underwater. Venezuela. Venezuela has the largest oil reserves in the world. They're heavy crude. They are across the Caribbean from US refineries who are set up to use it. But obviously, Venezuela currently has a socialist government and who have let the whole oil industry decay. If there was a change of government, then they could bring a lot of barrels online. But again, it would take time. What else could go wrong is that demand disappoints. The energy transition happens, IEA is correct, oil demand peaks. But seeing no sign of that at the moment. And if oil prices stay low, then you see, the US actual the energy efficiency, the oil, fuel efficiency of US vehicles has actually been declining.
So, Keith, the other thing about the energy transition happens is it can't happen because there aren't sufficient sources of necessary elements in order to allow it to happen. I was looking at a statistic the other day, which basically, we looked at, I think, probably a year and a half ago on Portfolio Matters Weekly, but the annual production of, let's say, nickel, world's annual production of nickel required to electrify 30% of the European vehicle fleet is something like 20 years by 2030. So the energy transition can't happen. I mean, either societies go back to the Stone Age, or oil production, oil production has to go. It's simply not possible. So there's a discontinuity in logic in the energy transition thesis.
Well, I agree, Richard.
I know you do, Keith.
So, pause, take a look at this because this is really interesting. This is from Wikipedia and it shows shale oil resources around the world. And what you want to look at is the US just compared with everyone else. The US has basically 10 times the shale resources of any other country. So when we talk about, potential shale coming online from other basins around the world, well, it's not going to be 11 million barrels a day. Argentina is forecast to grow to 1 million barrels a day by 2030, and that's the other big shale play currently.
The other point here is that North America has these enormous in-place shale oil reserves, but declining production.
Yeah,
So the percentage available, the percentage that you can tap is tiny.
right. Yes. See what you mean. But in the rest of the world, you mean,
Yeah,
compared to the US.
yeah. So if the rest of the world there is like 1/5 of the US's, which means that even if you
Yeah.
max out, you get 2 million barrels of oil a day
Yes.
from the rest.
Yeah, I see your point. Yeah.
And then after 10 or 15 years, if it follows the US strategy path, it'll be in decline.
Yeah, absolutely. Now, you'll notice that several countries we've talked about, like Argentina and Algeria, are not included in this table. So it's not comprehensive, but just the scale of the US compared to everywhere else is what you need to take away. So this is Venezuela. Venezuela has the largest oil reserves in the world, but it's all heavy oil. And a lot of conspiracy theories about Venezuela's oil reserves because they leapt starting in 2009. But that's because they got international auditors in to quantify how much heavy oil there was in the Orinoco belt. And so previously they didn't really know. And then they got international auditors in and they reported that there were 211 billion barrels. So the oil is probably there. But, this is the effect of socialism. If you get rid of the competent managers, US oil companies, and then you place them with a general whose only qualification is he's a crony of the boss, then this is what happens. Production goes from 2.5 million barrels to 500,000. So Venezuela could help. S&P Platts estimates that 10 billion would be needed to recover existing oil infrastructure, and output could increase by between 500 to 1 million barrels within 2 years if the right investment were made. So then back to the summary. I think you've heard it from me. Richard, what are your thoughts?
Yeah, I think it's right, Keith. I would say that because I've been rebalancing my portfolio of late because it got very heavily weighted towards precious metals.
Yeah.
I'm a firm believer in investing now in commodities and not much else.
Right.
And I believe that the EIA is wrong, that there isn't going to be, as you've pointed out there isn't going to be this massive oil surplus going into the future. The exploration budgets of all these big oil companies have been absolutely slashed. I read the other day that Total has slashed its exploration budget again. So new discoveries aren't being made. So there's a paucity of new discoveries, and they take years and years to bring on, even when they've been found. So I think inevitably, and we discussed the energy transition simply can't happen if the world remains as it is. The energy transition is impossible. It's a fantasy, which means fossil fuels will continue to have to provide a great deal of energy whilst nuclear displaces fossil fuel, which will take decades. And my thesis is that now is the time to start to move to rebalance part of my portfolio into fossil fuels.
Right.
So I've moved a bit some into oil, and I've moved some into coal.
Okay.
And if you
Well,
look at the
yeah.
shares of both, are actually, if you pick the right companies, are highly depressed.
Right. Well,
Just
very
another,
interesting what you bought, actually, Richard. Because I would say I'm going to hold off for now
yeah.
and see how next year develops, and we'll be following this every month, every time we do a podcast.
So what I would say in terms of my strategy is that I got into the precious metal market too early, a few years too early, and I'm accepting that this may result in the same situation.
Yeah.
But I'd rather be a bit early than late. I need to rebalance. I don't want to rebalance into anything that isn't commodity related.
Right.
So oil seems like a good bet. And it's a combination of speculative companies, which tend to be smaller, and also some big dividend producing companies. So this is a chart of US oil, which obviously is a
Yeah.
spot market. And it's in that huge declining wedge.
Yeah.
Nearly 4 year declining wedge. And it's not far from potentially either plateauing for some time along the x-axis, or breaking back out above it. But it looks unlikely that it's going to fall very much. It might fall down to the mid-50s, but it looks unlikely that it's going to fall very much further than that. And it looks very likely that the next substantial move, is going to be up.
Yeah. I don't disagree with that, Richard, but I think, a lot depends on what OPEC decide to do.
Yeah.
And the if the glut forecasts for next year are correct, then I see no prospect of a rising oil price.
So you may well be right. And my thinking is that if everybody starts to see a prospect of a rising oil price in a year or two, then there will start to be a bit of front running in the stocks. Now, I'm not expecting them to explode, but I am thinking now is not a bad time to be starting to put some money into them.
Well, in future, I frankly would probably intend to be very heavily overweight oil yet again.
Yeah.
Because the inelasticity of demand means the oil price will go through the roof, and that will take a wrecking ball to pretty much everything else. For just as an example, gold producers, they use a lot of energy, and so anything that uses oil, they're going to take a big hit to their earnings.
This is Newcastle coal, this is doing the same. It's doing the same thing. It's dropped from $454 a ton, presumably, to $100 a ton.
Yeah.
And it's going to do the same thing as oil, because it's one of the major sources of energy. It was also metallurgical coal is required for smelting steel, thermal coal for power stations. So this, to my mind, is in a similar situation to oil in terms of potential for investment.
Actually, can I just quickly, when you're talking about oil?
Yeah.
Now, so on the Discord, people were saying natural gas. There's growing demand, and in future, when rising as the amount of gas coming out of the Permian increases because the increasing gas to oil ratio, won't that support the profitability of shale oil companies and allow them to keep on drilling? Well, sadly, no is the answer, because there's limited, as I was talking about previously, there's limited takeaway pipeline capacity in the Permian, to the extent they're burning a lot of the excess. And of course, because all the pipelines are full, the price of gas actually at the wellhead you're getting is bugger all. And so when you look at the economics of a shale oil well in the Permian, only about 2.5% of revenue is coming from the gas.
Yeah.
And as the gas increases, and unless you increase the amount of pipeline capacity, that's not going to get better. It's more likely, actually, that in future, I mean, I don't know what Trump's done, but previously there were environmental controls about how much they were allowed to flare. If those were enforced by a future administration, it's likely that the
Oh,
shale drilling would be curtailed because you
yeah,
wouldn't want to flare the excess gas.
which would reduce supply even more. I think Goering and Rosenzweig, they produced a quarterly report, didn't they? Which is
Yeah.
a really interesting read. And they talk about gas in there, and their consideration is that the price of gas is going to rise substantially as well.
Yes, they're
And,
talking about peak gas in a couple of years.
yeah, and as you say, building a pipeline takes years and is hugely expensive, and you can't get it away from these places where it's being produced.
Yeah. Now, big caveat to all this is that people have been talking about peak oil literally since the 1960s. And I remember reading Twilight in the Desert back in 2005, talking about how the Saudi oil production was going to go into decline. Well, it ain't. And, shale then was totally unseen and came and, produced a huge supply glut. So there are plenty of hydrocarbons in the world.
Yeah, I think the but there, Keith, is that oil companies haven't been investing in the exploration. And therefore,
Precisely.
if you start now, it'll probably take 10 years for them to come on stream, or maybe, and that gap
Yeah.
where there's going to be a shortage.
Yes. And previously, when you think about prior to shale, the previous marginal producer was deep offshore.
Yeah.
And so you'd basically exploited any near shore, all the known basins, you were going deep water. And so if if the supply shock from US shale is at an end, you're going to have to go deep
Deep water.
water again, and
Yeah.
that's very expensive, and your oil price is going to rise. So that is my thesis.
And the oil price has to rise in order to make it profitable
Yeah,
exploration development. Yeah.
yeah. So
Which
that's the
benefits all
thesis.
which
Yeah,
then benefits the incumbent oil producers.
exactly. So, I'm not saying this is now, but it's on the horizon. I've I generally historically played the oil cycle quite well. It's a question of having patience to wait for the bottom and then having patience. This doesn't play out over the course of months, it
No.
plays out over the course of years.
Yeah.
And so,
Completely.
get in, yeah,
Get in and wait.
and
And
wait.
the key is you have to believe it, because if you don't
Yeah,
believe it, you won't stay in when the going gets hard.
yeah,
And you have to understand that it might take 5 years.
yes, exactly.
Hopefully it'll, if you're investing, hopefully it won't take 5 years, but it might do.
Yeah. Okay. Anything more, Richard?
No, very interesting, Keith. Thank you for preparing it.
Thank you all for watching. Please can you subscribe, and what else do we say? Yeah, and like the channel. And it's goodbye for Richard Wheater.
And it's goodbye for Keith Jordan.
Goodbye.
Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.